The Strait of Hormuz is closed. If you don't know what that is, here's why it matters. The Strait of Hormuz is a narrow stretch of water sitting between Iran and Oman, and roughly 20% of the world's entire oil supply passes through it every single day. Millions of barrels gone. And it's not just oil. Fertilizer shipments disrupted, helium disrupted, supply chains that most people have never heard of suddenly broken. Economists are throwing around the word recession. Energy prices are spiking globally, and people are scared. So let me ask you something. What do you think the stock market did? Did it crash? Did it spiral into a bear market? Did it do what every rational person on the planet expected it to do when a major global oil crisis hit? No. It hit all-time highs. Not just recovered, not just stabilized, all-time highs. In the middle of a war, in the middle of an oil shock, in the middle of what should have been a textbook market catastrophe. And this wasn't a slow grind back up over months. The S&P 500's 10-day return during this period landed in the 99.7th percentile of all 10-day returns in history. That means out of every 10-day window the market has ever had, this recovery was faster and stronger than almost all of them. So what is actually going on? Is this just a one-time fluke? Is the market broken? Is it being manipulated? Or is something deeper happening here? Something structural, something that has permanently changed how markets behave? My name is Kevin. I'm the curious retail investor. I've been investing and studying markets for 8 years, and when I dug into this question, what I found genuinely surprised me, because the answer isn't just about this war or this oil shock. It's about why the market has been doing this over and over again for the better part of a decade. And once you understand it, the way you think about investing will change. Let's get into it. Before we talk about why, let's establish something important first. This has happened before, many times, and the data is pretty remarkable. Think about World War II, the deadliest conflict in human history. The entire global economy reorganized around the war effort. Rationing, destruction, uncertainty on a scale that is almost unimaginable today. And the US stock market returned 17% over the course of that war, above the long-run average, during the deadliest war in human history. Korean War? Stocks up 19%. Vietnam? Complicated by a lot of overlapping economic events, but still positive over the full period. Iraq War? The S&P 500 rose 13.6% in the 3 months immediately after it began. Russia invades Ukraine in 2022, triggering the biggest land war in Europe since World War II, causing a massive energy crisis across the continent. The S&P 500 has risen more than 60% since that war began. Carson Research tracked 48 individual geopolitical shock events going all the way back to 1940, from Germany invading France to conflicts happening right now. And across all 48 of those events, the S&P 500 line does the same thing. It goes up every single time, without exception, over a long enough horizon. And here's the stat that really puts it in perspective. Across all major armed conflicts since World War II, the S&P 500 was positive 12 months later in approximately 70% of cases, with an average return in the high single digits. So the market hitting all-time highs during a war isn't an anomaly. It isn't the market being irrational. In fact, historically speaking, it's the norm. Most people just don't know that because it feels so counterintuitive every single time it happens. But that raises an even bigger question. If this is a pattern, why? What is it about the stock market that makes it so resilient, not just to wars, but to crashes, to pandemics, to tariff shocks, to oil crises? Why does it keep doing this V-shaped recovery over and over again, almost like it's on a spring? There are 3 reasons, and they stack on top of each other in a way that I think will genuinely change how you see the market. The first reason is something called the Fed put. Now, if you followed markets for any length of time, you've probably heard this phrase, but let's make sure we're really clear on what it means, because I think it's more powerful than most people realize. A put in investing is essentially insurance. It's a contract that protects you from losses below a certain level. If the market drops below that level, the put kicks in and covers you. The Fed put is the idea that the Federal Reserve acts as that insurance policy for the entire market. If things get bad enough, if the market drops hard enough, if the economy starts to crack, the Fed will step in. They'll cut interest rates, they'll print money, they'll do whatever it takes to keep the system from collapsing. And here's why this matters more today than it ever has before. Wall Street and Main Street used to be two different things. Rich people and institutions owned stocks. Regular people had savings accounts. A stock market crash was bad, sure, but it was mostly a problem for the wealthy. That is no longer true. US financial assets are now worth more than 5 times the entire GDP of the country. And household exposure to the stock market, meaning ordinary Americans with 401ks and index funds and retirement accounts, is higher today than it was during the peak of the dot-com bubble. Higher than 1999. Think about that. This means that a severe, sustained stock market crash isn't just a Wall Street problem anymore. It would devastate retirement savings for tens of millions of Americans. It would crush consumer confidence. It would ripple through the entire economy in a way that would be politically and economically catastrophic. The Fed knows this, Congress knows this, and that creates an implicit backstop. If things get bad enough, the policy response will come. And here's the fascinating thing that one of my favorite macro podcasters, Tyler from Forward Guidance by Blockworks, pointed out just days before the market started recovering to all-time highs during this latest crisis. He said something like, maybe things are so bad that the market is already anticipating the policy response. The market isn't just reacting to events, it's pricing in the rescue before the rescue even happens. That's the Fed put in action. And it's a real structural feature of the modern market that keeps floors under crashes that would have been much more severe in previous decades. But the Fed put does have one major weakness, and we'll get to that in a moment. First, let's talk about the second reason the market refuses to go down and stay down. Here's a number I want you to sit with for a second. In 1996, passive funds, index funds, ETFs, funds that just track the market rather than trying to beat it, represented about 6% of the US equity fund market. 6%. Today, that number is nearly 60%. In less than 30 years, passive investing went from a niche strategy used by a small minority of investors to the dominant form of investing in America. And this shift has fundamentally changed how the market behaves in ways that most people haven't fully internalized. Here's the key insight. Passive investors are price insensitive. What does that mean? It means that when you contribute to your 401k every 2 weeks, a portion of that money goes into the stock market. It doesn't matter if the market is up. It doesn't matter if the market is down. It doesn't matter if there's a war or a pandemic or an oil shock or a recession. The money goes in, like clockwork, automatically, without anyone making a decision. Across the entire US economy, millions of workers are doing this simultaneously, every single paycheck. And that creates a constant, steady, relentless stream of buying pressure that flows into the market regardless of what's happening in the world. Think about what that means during a crash. When bad news hits and sentiment crashes and people are panicking, there is still this massive mechanical river of money flowing into stocks. It doesn't panic. It doesn't read the headlines. It just buys. And this is why you've seen a pattern in the post-2008 era of corrections being sharp but short. The passive flow acts as a shock absorber. It keeps the market from falling too far because there's always fresh demand coming in on a fixed schedule. Now, there's an important nuance here that I want to be honest about. When you zoom out beyond just the fund industry and look at total stock ownership, passive strategies own somewhere between 30 and 35% of all US stocks. So the passive takeover is real, but it's not quite as complete as the 60% headline number suggests. Still, the directional point holds. A massive, growing portion of the market is now being driven by price-insensitive automatic flows, and that changes the game. But here's what's really interesting. If the Fed put is a floor built by policy, and passive investing is a floor built by habit, there's a third floor underneath both of them, and this one is the most fascinating of all, because most people have never heard of it. This is the part where I want you to really pay attention, because this is the piece that finally made everything click for me. There's a new layer of buyers in the stock market that most retail investors have never thought about. They don't read earnings reports. They don't care about valuations. They don't watch the news. They operate entirely on rules and algorithms. And they have grown so large over the past decade that they have fundamentally changed how the market behaves during sell-offs. There are two main groups here: trend-following funds, also known as CTAs, and options dealers. Let's start with CTAs. CTA stands for Commodity Trading Advisor, but don't let the name confuse you. These are large, systematic hedge funds that manage hundreds of billions of dollars and trade based purely on momentum and trend signals. They don't have opinions, they don't have convictions. Their models simply ask, is the market trending up or trending down, and then they position accordingly. Here's what happens during a market sell-off. When volatility spikes and prices fall, CTAs get a sell signal. They reduce their positions or go short. This can actually amplify the initial drop. But here's the critical part, and this is the piece that creates the V-shape. Once the selling exhausts itself and prices stabilize, the trend signal flips. The CTA models detect a new uptrend beginning, and they flip from sellers to systematic buyers, fast, mechanical at scale. And we saw this play out in real time just recently. In the wake of the latest crisis, Goldman Sachs estimated that CTAs were expected to purchase $85 billion in global equities in a single week, the largest systematic buying flow in the past 10 years. That's not driven by any fundamental catalyst. No earnings surprise, no policy announcement, just algorithmic portfolio rebalancing, detecting an uptrend, and buying accordingly. That's $85 billion in 1 week, mechanically. Now let's talk about options dealers. Options dealers are the firms that sit on the other side of options trades. When you buy an option, a dealer sells it to you. And to manage their risk, they constantly hedge their positions by buying or selling the underlying stock. Here's the fascinating part. The math of how options work means that when stock prices fall, dealers are often forced to buy stocks to stay hedged. And when prices rise, they sell. It creates an automatic mean reversion mechanism. The market falls, dealers buy. The market rises, dealers sell. It mechanically resists big moves in either direction. And this effect has been dramatically amplified by the explosion of zero DTE options, options that expire on the same day they're traded. Here's how fast this market has grown. In 2016, zero DTE options accounted for roughly 5% of S&P 500 options volume. By 2025, that number had exploded to nearly 60% of all SPX options volume, from 5% to 60% in less than a decade. And total SPX daily options volume doubled over that same period. What this means for market stability is profound. Because each zero DTE option expires at the end of the trading day, the gamma, the sensitivity of dealers' hedging positions, resets completely overnight. Every single morning, the market starts fresh. Whatever happened yesterday, whatever hedging positions were built up, they're gone. The slate is wiped clean, and dealers start hedging again from scratch. This means the market gets a fresh stabilization mechanism every single day. A sell-off that builds up gamma pressure during the day doesn't carry that pressure into the next session. The feedback loop breaks, and recovery can begin. Now put all three of these together, the Fed put, the passive flows, and these mechanical buyers, and you start to understand why corrections have been so sharp but so short in the modern era. In order to have a sustained crash, you would need to overwhelm all of these systems simultaneously. The Fed would have to be unable to respond. The passive flows would have to dry up or reverse, and the mechanical buyers would have to be on the wrong side of the trade all at once. That's not impossible, but it's a very high bar to clear. And it's why the market has done this V-shaped recovery over and over again in a way that has confused and frustrated bears for the better part of a decade. Okay, so does this mean bear markets are dead? Should we all just go maximum long and stop worrying? Not quite, and I want to be really honest here because I think the most irresponsible thing I could do is leave you with the impression that the market can never go down and stay down, because it can. There are specific conditions that can overwhelm all three of these floors simultaneously, and right now, at least one of them is worth watching closely. The first and most important off switch is inflation. The Fed put only works if the Fed is free to act, and the one thing that takes away that freedom is inflation. If prices are rising fast enough, the Fed can't cut rates or print money without making things worse. They become handcuffed, the safety net disappears. But it's actually more specific than that. The real constraint isn't even the Fed itself, it's the bond market. The Fed controls short-term rates, but the bond market sets long-term rates, the ones that actually affect mortgages, corporate borrowing, and the real economy. And if the bond market loses faith in the Fed's ability to control inflation, bond investors can simply refuse to buy. Yields rise, long-term rates go up, and the Fed's rescue gets undone before it even gets started. We saw a version of this dynamic in 2022, which is the one sustained bear market the post-2008 era has produced. The Fed was forced to raise rates aggressively to fight inflation. The bond market was in chaos, and the mechanical buyers and passive flows couldn't overcome the structural headwind of rising rates. The market fell over 20% and stayed down for the better part of a year. So, keep your eye on inflation. Keep your eye on the bond market. If those two things start flashing red at the same time, the rules of the game change. The second off switch is passive flows reversing. Remember those automatic 401k contributions that create the constant buying pressure. They depend on employed people having paychecks to contribute from. If unemployment rises sharply, those flows slow down. If a recession hits hard enough, people may start withdrawing from their accounts to cover living expenses. The river of automatic buying could slow to a trickle, or even reverse. And there's a longer-term structural pressure building here that I think deserves its own dedicated video. Every single day, approximately 11,000 baby boomers in the United States hit retirement age. And as they retire, they shift from accumulating assets, putting money into the market, to drawing down assets, taking money out of the market. Never before in history has so much market wealth been concentrated in a single generation that is simultaneously making this transition from accumulation to distribution. That is a slow-moving but potentially massive headwind for equity markets over the coming decade, and it's a story that is only just beginning to show up in the data. The third and final thing to watch is whether this is a sentiment shock or something structurally broken. Not every sell-off is equal. When the market drops because of a scary headline, a war, a tariff announcement, a bad jobs number, that's a sentiment shock. The underlying economy and corporate earnings are intact. The mechanical buyers and passive flows can overwhelm the fear relatively quickly. That's the V-shape. But when something is actually structurally broken, when banks are failing, when credit markets seize up, when the fundamental plumbing of the financial system is in trouble, that's a different animal entirely. That's 2008. And in that kind of environment, none of the floors I've described are sufficient on their own. So every time the market sells off, the question you need to ask isn't just, how bad does this look? It's, is something actually broken, or are people just scared? Most of the time, the answer is the latter. And that's why buying the dip has worked so consistently in the modern era. But it won't work every time, and knowing the difference is the most important skill a retail investor can develop. So let's bring this all together. The stock market hit all-time highs during a war, and now you know why. It's not random, it's not irrational, it's the result of three structural forces: the Fed put, the rise of passive investing, and a new layer of mechanical buyers that have fundamentally changed how the market behaves. Together, they create a system where corrections are sharp and violent, but self-limiting, where recoveries get reinforced by multiple layers of automatic buying stacking on top of each other, where the bar to sustain a crash is genuinely very high. But this system has an off switch. Inflation and bond market dysfunction can neutralize the Fed put. Rising unemployment can drain the passive flows, and the great boomer liquidation is a slow-building structural headwind that markets have never faced before at this scale. What does this mean practically for you as a retail investor? First, don't panic sell on headlines. The data across nearly a century of wars, crises, and shocks is overwhelming. Panic selling during scary events has been the most expensive mistake an investor can make over and over again. The best days in the market almost always come immediately after the worst ones. Missing those days by sitting in cash is a cost that compounds brutally over time. Second, understand what kind of sell-off you're looking at. Is something structurally broken, or are people just scared? That question is worth spending 5 minutes on before you make any decision. Third, keep your eyes on inflation and the bond market. Those are your early warning system. If both are flashing red simultaneously, the playbook changes. And fourth, don't mistake a system that's hard to break for a system that's impossible to break. The market is resilient, it is not invincible, and the investors who understand the difference are the ones who will be in the best position when the environment eventually does shift. I'm Kevin. If you want me to dig into the boomer withdrawal question in detail, when those flows actually start reversing and what the historical data says about the potential impact, let me know in the comments. That's a video I'm genuinely excited to make. And if this one was useful to you, please like, subscribe, and check out my breakdown of the private credit situation, because that is another story that most retail investors are completely underestimating. See you in the next one.